Listen, something major just happened in the silver market, and if you don't understand what it's signaling, you could walk straight into a trap that's been building for years. While most people were distracted by holiday celebrations, while Western markets were closed, while traders were away from their desks, physical silver in retail shops across China reached $91 per ounce. Right now, not theoretical, not projected, not some analyst's forecast, real transaction pricing, real deals being done, metal actually changing hands. And at the same time, COMEX, the exchange that's supposed to anchor the global price of silver, is still sitting around $79.59. That's not normal. That's not market noise. That's not some temporary dislocation that will fix itself when everyone returns to work. That's an $11.41 gap between what physical silver truly costs and what paper contracts claim it's worth, and that gap is about to force a reckoning when markets reopen Monday morning. Before we go further, I need to be clear. Nothing here is financial advice. I'm not telling you what to buy or sell. I'm laying out facts, mechanics, and historical patterns. You're responsible for your own decisions. If you want real-time breakdowns like this, the kind of detail mainstream coverage avoids because it's too uncomfortable, too revealing, too risky for the narrative they're trying to protect, subscribe, turn on notifications, and drop a comment. Do you own silver, or are you watching from the sidelines? Because what happens when markets reopen on Monday could be fast, violent, and irreversible. And your position, whether you're long, short, or sitting in cash, will decide whether you profit or get crushed. In this deep investigation, I'm going to show you exactly what this $11.41 gap really means and why it isn't the same as normal premiums. I'm going to explain the Monday trap, the two scenarios that could unfold when Western markets open, and why both paths involve violence. I'm going to lay out why retail pricing in China matters far more than most analysts realize, and why it's the canary in the coal mine for the entire silver market. I'm going to unpack the structural weakness in paper markets and why the arbitrage mechanism that's supposed to close gaps is actually exposing them instead. I'm going to show you the industrial demand drivers that make physical demand inelastic and why that inelasticity creates explosive price moves. And I'm going to give you the specific signals to watch Monday morning so you'll know which scenario is unfolding in real time. This is the story of the $91 silver shock the day Shanghai printed reality, while COMEX clung to fiction, and why Monday will force the paper market to choose between capitulation and chaos. Here's the core situation, and I want you to focus on these numbers because they're not opinions. They're not models. They're verified data points from the physical market. Physical retail silver in China is hovering near $91 per ounce. The COMEX paper reference is roughly $79.59. That's a split market, two prices for the same metal. One price where real physical transactions happen and another price where financial contracts trade. And when that happens in any critical commodity, when physical and paper separate by more than 14%, the outcome is almost never gentle. It's forced. Now I want to be precise here because skeptics will instantly say those are retail prices. Retail always carries premiums. You're comparing apples to oranges. And yes, retail shop pricing includes premiums. That premium isn't automatically manipulation or gouging. It reflects real costs, fabrication costs, the cost of turning raw silver into bars or coins, availability costs, the premium you pay for immediate delivery instead of waiting logistics costs, the cost of getting metal into the shop in urgency, costs, the premium that appears when supply is tight and buyers compete. All of those are legitimate components of retail pricing. But here's what matters. Even after you account for those premiums, even after you strip out the normal markup that retail always carries when physical clears this far above paper, it's telling you something uncomfortable. The screen price is starting to matter less than the delivery price. Think about what that implies. For decades, COMEX set the price. Miners used COMEX as a reference. Manufacturers used COMEX as a reference. Investors used COMEX as a reference. The paper price was the price. But when physical markets in China are transacting at $91 and paper markets in New York are showing $79.59, the question becomes, which one is real? Which one reflects true supply and demand? Which one can you actually execute at if you need metal? And the answer is becoming clearer. The physical price is real. The paper price is behind. And once the delivery price starts, leading paper pricing loses authority. It becomes derivative secondary, something that follows instead of leads. And once that psychological shift takes hold, once participants stop trusting the paper price, the paper market loses control. That's the Monday trap. When Western markets reopen, this $11 plus gap has to resolve. It can't hang there forever. The market will force a resolution. But that resolution can happen in two very different ways, and understanding both scenarios is critical. Scenario A, paper chases physical. COMEX gaps up and starts moving toward the $91 reality. Maybe it opens at $83, maybe $85. It jumps to close the gap. That triggers short covering. Traders who sold silver at $77 or $78 are suddenly underwater. Their brokers call for more margin. Some panic and cover. Their covering becomes forced buying, which pushes price higher. That triggers stop-loss orders. Traders who had stops at $82 or $83 get hit. Those stops turn into market orders to buy. More buying pressure, more upward momentum, and then the algorithms kick in. HFT systems detect the breakout pile in, and the move turns into a cascade. Price moves like an elevator, not stairs. It doesn't climb gradually. It jumps $79 to $83 to $86 to $89 in a matter of hours, maybe minutes. This is what happens when paper finally gives way to physical reality. The adjustment turns violent because it was delayed. The gap that should have closed gradually over weeks gets closed in hours. All the buying pressure that was held back by denial suddenly releases in one burst. Scenario B, paper tries to crush the narrative. Heavy sell programs slam the open. Large institutional sellers, possibly bullion banks sitting short, dump massive quantities of futures contracts within minutes. The screen turns red. Price drops from $79.59 to $77 to $75. The headline screams silver crashes. China premium was fake. Retail traders panic and sell. Stop losses get hit on the downside. And the narrative becomes, see, the physical premium was temporary. The real price is what COMEX says. Everyone calm down. This is psychological warfare. The goal isn't to reflect supply and demand. The goal is to convince everyone that the paper price is the real price and the physical price is an anomaly. To shake out late buyers to rebuild confidence in the paper reference to prove COMEX is still in control. But here's the problem with scenario B. It only works if physical demand cools off. If after the smash, Chinese buyers shrug and stop paying $91, if dealers lower their asking prices, if the physical market accepts the paper market's verdict. But what if they don't? What if shops across China are still clearing near $91 even after COMEX drops to $75? Then the gap just got wider. It went from $11 to $16. And that wider gap proves the opposite of what the smash was meant to prove. It shows the physical market doesn't care what COMEX does. It proves physical demand is real, urgent, and inelastic. And once that's proven, the smash fails. Price recovers within hours or days. And when it recovers, it goes higher than before because the smash shook out weak hands, transferred silver from panicked sellers to strong hands, and confirmed the physical market is leading. So Monday becomes a test of control. Does paper successfully intimidate physical, or does physical reality drag paper upward? Either way, volatility risk is high, especially for leverage traders. If you're trading with 10 or 20 times leverage, scenario B can wipe you out. Even if you're right about the long-term thesis, right about physical demand, right about supply shortage, right about the direction, if you get stopped out in a flash crash, you're done. You don't get to participate in the recovery. This is why leverage is dangerous during structural transitions. The path might be correct, but the volatility can destroy you. Comment below. Does the gap close up or does it close down? And do you believe the physical market is starting to lead price discovery? Because that's the fundamental question. Is this just a temporary premium that fades away, or is this the start of a lasting shift where physical demand starts asserting authority over paper? In part 2, we're going to explain why retail pricing matters more than most people realize. Because retail is where physical tightness shows up first. And what's visible in Chinese shops today will be impossible to ignore in Western markets within weeks. Stay with me. We're going into the mechanism of price discovery. If you're just joining us, we've established that physical silver in Chinese shops is at $91 while COMEX is showing $79.59. That's an $11.41 gap, and we've outlined the two scenarios for Monday's open. In part 1, we laid out the gap in the Monday trap. In part 2, we need to explain why retail pricing matters, because a lot of people hear China shops and assume it's irrelevant. That's just retail. That's not the real market. The real market is COMEX or LBMA. Wrong. Completely wrong. And here's why. Retail pricing is where physical tightness becomes visible first. Because retail has one brutal rule: when a metal is scarce, its price adjusts immediately. There's no smoothing, no managing, no public relations. If a dealer has limited inventory and 10 buyers want it, the price rises until only the most urgent buyers remain. That's supply and demand in its purest form. But paper markets can delay reality. They can manage perception. They can use derivatives to create synthetic supply. They can roll contracts forward to avoid delivery. They have tools to maintain the fiction that everything is fine. Retail can't do any of that. Retail is cash and carry. You pay, you get metal, or you don't. There's no complexity, no leverage, no rolling, just physical settlement. And when enough buyers are willing to pay nearly $91 in the real world, that does two things. First, it pressures wholesalers and refiners upstream. Because if retail is selling at $91, wholesalers need to charge retailers $89 or they can't make a margin. And if wholesalers are paying 89, refiners need to charge them 87. And if refiners are paying 87 for raw material, miners can charge 85. The retail price sets the floor for the entire supply chain. It pushes backward. And second, it changes psychology because the public starts realizing, wait, silver is not actually $79.59 if I try to buy it. They see the screen price they go to buy, and they're quoted $91. That creates cognitive dissonance. Which price is real? More and more people conclude the real price is what they have to pay, not what the screen shows. That's how narratives break. Because the price isn't what a screen says. It's what a seller will actually hand you metal for. And right now in China, that price is $91. Now, let me explain why China specifically matters. China isn't a small retail market. It's the manufacturing center of the world. China makes solar panels, electric vehicles, electronics, and batteries. And all of those products require silver. So when Chinese retail shops are pricing silver at $91, it's not just retail investors buying. It's procurement managers from factories. It's industrial buyers locking in supply. It's manufacturers hedging against future shortages. These are not speculators. These are people who need physical metal to keep production lines running. And they're willing to pay $91 because the alternative is worse. The alternative is waiting and hoping metal becomes available later. It's risking production delays. It's losing contracts because you can't deliver products. So they pay the $91, they secure the metal, they move on, and their buying keeps the price elevated. This is very different from speculative demand. Speculative demand is elastic. When the price rises, speculators back off. They wait for a pullback. They trade around the volatility. But industrial demand is inelastic. When the price rises, industrial buyers absorb it because their demand is driven by production needs, not price levels. They need a certain number of kilograms of silver per month, regardless of whether it costs $79 or $91. And that inelasticity is what makes physical markets powerful. Once physical demand tightens, price becomes the only adjustment mechanism. And that price can run much further than models predict because the models assume demand is elastic. They assume higher prices reduce demand. But in industrial markets, higher prices don't reduce demand. They simply transfer the cost to customers. The solar panel costs $100 more. The EV costs $150 more. The smartphone costs $20 more. Customers pay, production continues, and silver demand continues. In part 3, we're going to break down the structural weakness in COMEX. Because understanding why the paper market is vulnerable is critical to understanding why this gap matters. Stay with me. We're going into the mechanics of the leverage trap. We've reached part 3. We've shown the $11.41 gap and the Monday scenarios. We've explained why retail pricing matters and why industrial demand is inelastic. Now we need to talk about structure, the structure of paper markets, and why that structure becomes fragile when physical tightness emerges. Let's start with what COMEX actually is. COMEX is a futures exchange. It allows traders to buy and sell contracts representing future delivery of silver. Each contract represents 5,000 ounces. Traders can go long betting the price rises or short betting it falls. A huge portion of this activity is financial settlement. Most contracts are rolled, closed, or cash settled. Only a tiny fraction, maybe 2 to 3%, result in actual physical delivery. The system works beautifully as long as two conditions hold. First, physical demand stays calm. As long as most participants are trading for price exposure rather than actual metal, the system functions. Second, confidence stays intact. As long as everyone believes physical delivery is available if needed, the paper market maintains authority. But when either condition breaks, the system's weakness shows. Paper is leverage, physical is final settlement. Let me explain the leverage structure. To buy one COMEX silver contract representing 5,000 ounces, you don't need $400,000. You need margin, which might be $8,000 to $15,000 depending on volatility. That's roughly 50 to 1 to 25 to 1 leverage. This leverage enables massive speculation, price discovery, and liquidity. But it also means the paper market can represent far more silver than actually exists in deliverable form. COMEX open interest often exceeds 900 million ounces, but registered inventory, the metal available for delivery, is below 70 million ounces. That's a leverage ratio of 13 to 1. For every physical ounce in the vault, there are 13 paper claims. This works fine as long as only 2 to 3% of contracts demand delivery. But what if 10% demand delivery? What if industrial buyers seeing the $11 gap decide to buy COMEX contracts and demand delivery to arbitrage the gap? Suddenly, the exchange needs to deliver 90 million ounces, but they only have 70 million. They're 20 million ounces short. What happens? Force majeure, cash, settlement rule, changes chaos. This is the structural weakness. The paper market is built on the assumption that physical demand stays low. But when physical tightness emerges, when buyers actually want metal rather than just price exposure, that assumption breaks and the system becomes fragile. Now let's talk about arbitrage. Textbook theory says buy cheap in New York, ship sell high, and China gap closes. Simple, elegant, risk-free profit. But reality says arbitrage requires metal time, logistics approvals, and inventory that can actually be delivered. Let me walk through the real arbitrage process. Step 1, buy COMEX futures at $79.59. Step 2, request physical delivery. This is where it gets complicated. You need an approved warehouse receipt. You need to coordinate with the vault. You need to wait for the delivery window, which might be weeks away. Step 3. Once you have the metal arranged, shipping to China international, shipping insurance, customs documentation, export approvals, import approvals, more weeks, more cost, more risk. Step 4. Sell in China at $91. But by the time you complete steps 1 through 3, the price might have changed. You're carrying price risk during the entire process. And here's the critical insight. When tightness is real, when physical supply is genuinely constrained, arbitrage doesn't close the gap. It exposes the gap. Because the more people try to pull metal out of paper systems, the more stressed the system becomes. Registered inventory drops, delivery delays increase, premiums widen. The act of arbitrage proves the shortage is real, and that attracts more arbitrage attempts, which drains more inventory, which proves the shortage further. This is a positive feedback loop, and that's how you get persistent divergence. The gap persists because arbitrage reveals the underlying tightness. Quietly at first, a small premium appears. It grows. Now it's obvious. The paper market doesn't have the metal to satisfy arbitrage demand. In Part 4, we're going to detail the industrial demand drivers, because understanding why physical demand is inelastic and growing is critical to understanding why this gap will widen, not narrow. Stay with me. We're going into the supply chain that makes silver irreplaceable. We've reached Part 4. We've shown the gap, the Monday scenarios, why retail matters, and the structural weakness in paper markets. Now we need to address demand, because silver is not just an investment story. It's a supply chain story. And the demand drivers don't pause just because the price rises. Let me lay them out. Solar. Solar panels require silver paste to conduct electricity. There's no substitute that keeps efficiency intact. China is installing hundreds of gigawatts of solar capacity. Europe has renewable mandates. The US has subsidies. Global solar deployment is accelerating, and newer panels use more silver, not less. TOPCon and HJT technology require 50 to 80% more silver than older PERC cells. So as the solar industry upgrades, silver usage per panel increases. Current estimates put solar silver demand at 200 million ounces annually and rising. Then there's electrification. The entire global economy is electrifying. EVs replacing combustion engines, heat pumps replacing gas furnaces, induction stoves replacing gas stoves, electric trains replacing diesel. Every time we plug something in, we need more wires, more circuits, more connections. And silver is the best conductor of electricity on the planet. It has the lowest resistance, which means the least energy loss. So as the world electrifies, demand for silver keeps climbing. Take electric vehicles. A regular car uses about 15 to 20 grams of silver. An EV needs 30 to 50 grams. But here's the key point. The next generation of EVs with solid-state batteries could use between 500 grams and a full kilogram of silver each. If we start making 30 million of those cars a year, that's 15 million kilograms of silver. That's over 482 million ounces, more than half of all the silver mined in a year just for EVs. Then there's electronics. Your smartphone, tablet, laptop, TV, even your fridge. Every single one has silver in it. The average smartphone contains about 0.2 grams. With 1.5 billion smartphones made each year, that's another 9.6 million ounces of silver. And that's not even counting all the other gadgets we use. And what about the AI boom? It's driving an explosion in data center construction. Every server, every cooling system, every power grid in these massive facilities requires silver. We're building them at a pace we've never seen before, and each one is a major consumer of silver. Silver is also crucial in medicine. It's antimicrobial, meaning it kills bacteria on contact. So it's used in everything from wound dressings and surgical tools to catheters and hospital equipment. With an aging global population, healthcare demand is rising, and so is the need for medical silver. Even defense systems rely on silver. Missiles, radar, communication, gear, night vision, they all contain silver. As geopolitical tensions increase, countries are upgrading and expanding their military capabilities, which means more demand for silver. Now here's the critical part. This industrial demand is inelastic. Industrial buyers aren't trying to speculate on the price. They need to secure their supply. If the price of silver jumps from $79 to $91, a solar panel manufacturer doesn't just stop production. They can't. They have contracts to fulfill, deadlines to meet, and customers waiting. So they pay the $91. They absorb the cost and pass it on to their customers. The solar panel might cost a bit more, but production keeps moving and the demand for silver continues. This is completely different from investment demand. An investor might see silver at $91 and think, that's a bit steep. I'll wait for a dip. They can afford to wait because they don't actually need the physical metal, but a manufacturer can't wait. For them, availability matters more than price. This inelasticity is what can trigger explosive price moves in commodity markets. When demand doesn't respond to price, either supply has to increase or the price has to go high enough to destroy demand. But for silver, demand destruction would require prices to reach extreme levels, maybe $200, $300 an ounce or even higher. Because even at $300 an ounce, the amount of silver in a $50,000 EV or a $500,000 solar installation is still a tiny fraction of the total cost. The products remain viable, demand continues, and the price keeps climbing until new supply comes online. But as we've talked about before, bringing new supply to the market takes a very long time. It can take 10 to 15 years to get a new mine from discovery to production. So for the next 5 to 10 years, supply is pretty much fixed. Meanwhile, demand is growing exponentially, solar is doubling, EV production is doubling, data centers are doubling. The math just doesn't add up. There isn't enough silver at current prices to meet all this projected demand. So the price must rise, not might rise. It must rise. It's the only way to ration limited supply among all the competing buyers. The $91 physical price we're seeing in China is exactly that rationing mechanism at work. The market is saying, if you need silver right now, you pay $91. If you can wait, you pay less, but you risk not getting any metal at all. So what do buyers do? They choose urgency. They pay the $91, and that price sets a new floor. In this final part, we're giving you the specific signals to watch for on Monday morning. Understanding the big picture matters, but knowing what to look for in real time is what really counts. We've laid it all out, the $11 gap between physical and paper prices, the Monday trap scenarios, why retail investors are key, why the COMEX is weak, and why industrial demand won't back down. Now let's get to the battle plan. Here are the signals to watch when the markets open. Signal 1, does the COMEX price move up and stay above key levels? This is the most important one. If COMEX opens at $83 and holds above 81 through the morning, that's scenario A. It means the paper market is following the physical price. Shorts are covering and momentum is building. Holding matters more than spiking. A quick pop to 84 that immediately drops back to 78 means sellers are still in control. But if the price grinds up to 83 and holds and then to 84 and holds, that's sustained buying. That means shorts are trapped. Watch the hourly closes. Higher closes mean momentum is building. Signal 2, do physical premiums stay high? This is your confirmation. If Chinese dealers lower their prices on Monday, it might mean the physical demand was only temporary. But if Monday afternoon comes and they're still asking for $91 or more, it confirms the demand is real and sustained. That will force the paper markets to face reality. Keep an eye on reports from dealers and commodity news. Signal 3, does the spread between paper and physical shrink because paper rises or because physical falls? This tells you who's driving. If COMEX jumps from $79.59 to 86, while China stays at 91, the paper price is chasing the physical price. That's scenario A confirmed. But if China's price drops to 82 while COMEX stays put, that means physical capitulated to paper. That's scenario B. You want to see the paper price rising to meet the physical. Signal 4, are there any signs of inventory, stress, or supply issues? This confirms a real shortage. Look for reports of delivery delays, refineries rationing supply, or mints suspending sales. These are all signs of physical tightness, and they make the paper market more vulnerable. If someone tries to take a large delivery from COMEX and runs into trouble, that's big news. Signal 5, watch the volatility. Huge price swings up and down suggest a battle between buyers and sellers. But if the price steadily grinds higher with calm action, it suggests buyers are overwhelming sellers. A massive dump that doesn't recover suggests sellers have won the day. The character of the price action tells you a lot. So here's how to interpret all this. If signals 1, 2, and 3 all point to scenario A, paper chasing physical, then our thesis is being confirmed. The repricing event is underway. Expect upward momentum as shorts get squeezed and the media starts paying attention. We could see prices push toward $91, $96, or even $100. If the signals point to scenario B, paper driving the price down, it might mean the physical demand wasn't as strong as it looked. Expect a pullback. But even then, if physical premiums stay high, it might just be setting the stage for an even bigger move up later. A failed smash is the most bullish setup of all, because it proves the physical demand is real and the paper suppression is only temporary. If you're positioned in this market, here's what you need to know. If you own physical silver, you're in good shape. You own the real asset. Don't panic if Monday brings a price drop. The long-term fundamentals haven't changed. That $91 price in China shows there's real tightness. If you're trading with leverage, be extremely careful. Monday could be volatile. You could get stopped out even if the long-term trend is up. Consider trimming your leverage. All right, let's talk about what's happening with silver, because it's getting wild. If you're currently in a trade, you need to seriously consider widening your stops. Or even better, step aside and wait for clarity. Think about it. What's the real cost of missing one day's move? It's small compared to the catastrophic risk of getting completely wiped out. Now, if you're holding a short position on silver, you're in an extraordinarily dangerous spot right now. The risk to reward ratio is awful. Best case scenario, maybe you make a few dollars if the price dips a little. But if the price rips higher, say COMEX gaps up to $86, you're facing massive, potentially account-destroying losses. The smartest, most prudent move here is to cover your short, take your chips off the table, and wait. On the other hand, what if you're sitting in cash, waiting for that perfect moment to buy? You need to understand that waiting for the perfect entry might mean you miss the entire move. If COMEX does gap up to $86 and then runs toward 91, that pullback you're hoping for might never happen. Or it could be a tiny $2 dip that lasts 15 minutes before the price takes off again. This is a key point. Physical markets experiencing a shortage don't give you comfortable, easy entry points. They give you violent, explosive entries. You either get positioned ahead of the big move or you end up chasing it higher. And we all know what happens when you chase. You usually end up buying right near the top. So here's the bottom line. Seeing physical silver at $91 an ounce in China while the COMEX paper price is sitting at $79.59, is that just some cute little anomaly? This isn't a retail markup you can just dismiss, and it's definitely not temporary market noise that's going to fade away. This is a major stress signal. It's the physical market screaming at you that supply is incredibly tight, demand is urgent, and the paper price is flat out wrong. History shows that when the physical market starts leading, the paper market eventually has to follow. And it doesn't follow politely. It doesn't happen gradually on a smooth chart with nice clean support levels. No, it's forced. It happens violently through massive price gaps, cascading buy orders, brutal short squeezes, and pure chaos. And this coming Monday morning is when the market will be forced to decide. Will the paper market successfully defend its $79.59 narrative? Or will the undeniable reality of the physical market force paper to recognize the $91 price? One way or another, Monday is going to answer a question the silver market has been avoiding for years. That question is simple. Which market is real? Which price truly reflects actual supply and demand? Which system holds the ultimate authority? For decades, the answer felt clear. The COMEX was real. The COMEX had authority. Physical markets were treated like a sideshow, a secondary concern. But that long-standing hierarchy is cracking right in front of us. The physical markets, especially in places like Shanghai, are asserting a completely different price. And if that price holds, if Monday's trading confirms that $91 level, then the authority has officially shifted. Physical will lead, paper will be forced to follow. And that massive repricing everyone said couldn't happen, the one that was impossible and supposedly violated all the sophisticated models, suddenly becomes inevitable. This is a critical moment and you'll want to stay on top of it. Make sure you subscribe and turn on notifications because we will be tracking this in real time. We will report the market open. We'll monitor all the key signals. We will document whether the market erupts higher or gets pushed back down. And most importantly, we will explain what it all means for the next phase of this market. I want to hear from you. Drop a comment below. Do you think Monday will close the gap by moving up or will it be pushed back down? Your answer really shows whether you grasp the magnitude of what's happening right now. This isn't just about some short-term trade. This is about a deep structural shift in a globally critical commodity market. It's a shift away from paper control and toward physical reality. And in shifts like these, fortunes are made and fortunes are lost. You need to make absolutely sure you're on the right side of this move. That $91 silver shock happened while you were sleeping. Come Monday morning, the whole world is going to wake up to it, and I promise you things will not be the same. Don't forget to like this video and subscribe to the channel so you can get new updates firsthand. Thanks for watching, and I'll see you in the next.